Welcome back to Investing Talk Podcast.
Today we're looking at ALAB.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. This company, it sits right at the core of the whole AI infrastructure build-out.
The absolute core.
And their recent financials, they really confirm that. This isn't just hype.
No, not at all. Let's start with those financials because the numbers for Q3, they're kind of explosive, right?
Explosive is a good word. We're talking revenue of, what, $230.58 million?
Yeah, and that's a year-over-year growth of over 100%. That kind of velocity is just, well, it's what this whole AI story is about.
It is. But what's maybe even more critical here is the profitability turnaround.
Right. The shift from losing money.
Exactly. They posted a net income of $91.11 million for the quarter. And that demonstrates some serious operating leverage.
So basically, all that surging demand from AI data centers is just flowing straight to the bottom line.
Straight to the bottom line. Their net margin shot up to around 39%, which for a semiconductor company, that's phenomenal. It tells you they have real pricing power.
And it doesn't look like they're slowing down either. What is management forecasting?
Well, near term, for Q4, they're guiding for somewhere between $245 and $253 million. So, steady growth.
Oh, yeah.
But the long-term view, that's where it gets really aggressive. They're projecting $1.5 billion in revenue for 2028.
Wow, $1.5 billion.
And $393.5 million in net income. That implies a 34% compound annual growth rate from 2025. Just massive.
So to support that kind of growth, what does the balance sheet look like? Is the foundation strong?
It is very strong. They have low leverage, a high cash position, and they're generating a lot of cash from operations. So they can fund their own R&D without taking on a ton of debt.
Which is critical in this space.
Absolutely. So, okay, let's unpack this a little. That 39% net margin suggests they have a serious competitive edge, a real moat.
Yeah. How does a smaller, specialized company like this win against the giants?
It's all about that specialization. They are laser focused on one thing, AI and cloud data center connectivity. They serve the top tier players, the hyperscalers.
Amazon, Microsoft.
Yeah.
Those guys.
Exactly. And their moat, it's really built on three pillars. First, their own custom silicon. Second, a really strong IP portfolio. And third, and this is key, deep integration into their customers' systems.
So once a customer designs their product in, it's just really hard to switch out.
It's incredibly expensive and time-consuming to switch. You have these long design win cycles, so once Astera is baked into the architecture for a new data center, they are in.
That creates some serious client stickiness.
Very high switching costs. But, and this is the big but, that leads directly to the single biggest risk factor here.
Let me guess. Customer concentration.
You got it. They are heavily reliant on just a handful of those hyperscalers. If any one of them cuts back on orders, it could really hurt that growth story.
So is management doing anything to, spread the risk around?
They are. They're actively trying to expand their product lines and also their customer base. They're moving into new technologies, trying to get beyond that core concentration risk.
Okay, that makes sense. Let's pivot to the stock itself then, the technicals. Because despite all this incredible fundamental news, the stock's been really volatile.
Extremely volatile. Classic for a high-growth name. The price as of November 11th is sitting around $173.74.
And I see there was a pretty recent pullback.
There was. And that dip pushed the 14-day RSI, the Relative Strength Index, down to 28.27.
Okay, here's where it gets interesting for traders. An RSI below 30. That's a key level, isn't it?
It is. It's typically considered oversold. It suggests the selling pressure got a little ahead of itself, and the price might be due for a near-term bounce.
So it's sitting right near a support level.
Yeah, baseline support seems to be around $167.50, and it's still way above its long-term 200-day moving average, which is down at $121.40. So the long-term trend is still very much up.
And what's Wall Street saying? Are analysts buying into this aggressive growth story?
They are. Consensus is a strong buy from almost 24 firms. Average price targets are in the, 170s up to over $200.
And the high target?
The high forecast is all the way up at $275. So a lot of perceived upside. We're also seeing big institutions increasing their ownership.
So looking forward, what are the key dates or events investors should have on their calendar?
The immediate one is Q4 earnings. That'll be late January, maybe early February 2026. Any surprise above that $245 to $253 million guidance would be a huge catalyst.
Any other big days?
Yes, definitely watch for their Analyst and Investor Day. It's scheduled for mid-February. That's usually where management will refresh their guidance and maybe give more color on that big 2028 target.
And on the more speculative side, I've seen some M&A chatter. What's the thinking there?
Well, a company with this kind of specialized IP and deep customer relationships, it makes them a very attractive takeover target.
For one of the big guys, like an AMD or an Intel.
Exactly. Someone looking to instantly deepen their AI exposure. It's totally unconfirmed, of course, but that rumor adds a little optionality to the story.
Okay, so let's try and summarize the whole picture. We know the biggest risk is customer concentration. But let's talk about that valuation.
We have to. It's the elephant in the room.
The PE ratio recently hit 147.
Yeah, 147.
That's not just a premium. That's a valuation that is pricing in years of absolute perfection.
There is zero room for error at that multiple. Any miss on guidance, any sign of slowing growth, and a stock price like that could get hit really, really hard.
So putting it all together, what's the final investment thesis here?
You know, the overall rating from the sources we've seen is highly bullish, a 9 out of 10. The rationale is all based on that accelerating growth, the expanding margins, and the structural AI tailwinds.
Plus the oversold technicals, which could be a decent entry point.
Exactly, so you could see it as a short-term trade into earnings.
Or a long-term bet on the whole AI infrastructure build-out.
Right, it works for both, but with very different risk profiles. The long-term hold requires a stomach for some serious volatility.
It really all comes back to that 2028 forecast, doesn't it? That $1.5 billion in revenue. You have to ask yourself, do you believe the AI infrastructure growth is powerful enough to hit those targets and therefore justify the premium valuation we see today?